Hello, everyone. Welcome back to another live stream. Today, we are talking about Joe Biden's infrastructure package, mostly today, but we are also talking about Jay Powell, and we're talking about earnings, which means there's so much stuff going on. But Jay Powell and the Federal Open Market Committee are releasing a statement within the next 6 minutes. In this statement, we will hear whether or not interest rates will be going up, and we will be looking for any kind of signs of a taper or any kind of change in strategy from the Fed. Obviously, we are not expecting anything to change, but after we review the statement and we go through the verbiage in the statement, we will also be looking at what the heck what Jerome Powell says in the Q&A that does begin at 2:30 p.m. Eastern time. So basically, next 5-6 minutes, we'll kind of take a look at the markets. Then we'll look at the statement. We'll analyze the statement. We'll get some reactions. We'll see what's happening. We'll get reactions maybe from Bloomberg, from CNBC. We'll see how the market's reacting. So we'll take a look at the sticks, obviously. And then we will go into the Jerome Powell Q&A. The Mind Medicine interview, unfortunately, got rescheduled super last minute, like within the last little bit here. I mean, we were just in the course member live stream expecting it to still happen. And it has just gotten rescheduled, which is unfortunate. I don't have a date yet for when, but apparently there's some kind of compliance blackout for MindMed after this uplisting. So instead, we will be talking through through Jerome Powell's Q&A session. So we'll get to cover all of that. All right, so we are on standby for that Federal Reserve statement to be coming out. That statement is expected to be released within the next 5 minutes. Let's go ahead and take a peek to see how the market is performing right now. I know the NASDAQ's down. We'll take a look at the S&P. The S&P, let's see, we'll start with SPY. Pretty much flat. S&P's been pretty darn flat most of the day today as we are on standby for these notes to get released from the Federal Reserve. So we're trading a little bit lower there on the S&P 500, but fractionally lower on the day. Let's take a look at the NASDAQ. Let's grab the NASDAQ 100, for example. NASDAQ 100 is down slightly. Let's see if we can, there we go, actually show the details here on the right. There we go. Down about 0.25% on the NASDAQ. Let's take a look at the Dow Jones. Dow, I'll have to have these on like a cleaner list. In fact, I might do that. I'll just pull up the it's volatility index. I'll pull up the Bloomberg and we'll have the indices up like that. Otherwise, in terms of the actual market itself outside of the indices, while we wait for the statement and release from Jerome Powell, we have Enphase and Pinterest both suffering and kind of continuing to trend down throughout the day. They've been sitting around negative 14% here after really bad earnings guidance. Great earnings report, but a bad guidance. Then we've got let's see, Spotify. Spotify is down 10.6%, which is a little confusing because Shopify is up about 10%. There we go. Let's take a look at the indices here.
Reserve's decision on interest rate. Stocks right now are flat to modestly lower. The S&P 500 just barely in the red. Basically flat. The 10-year yield about 1.65%. So there are your benchmarks as we see what market reaction, if any, there is from today's Fed decision on interest rates. Let's get straight to our panel for now, led by Mona Mahajan, Senior U.S. Investment Strategist at Powell.
Yeah, so they'll have panel commentary here over the next 20 minutes as we go into the Joe Biden. I keep saying Joe Biden because Joe Biden is talking today. As we go into the Jerome Powell Q&A, we'll be covering the complete Q&A. I'll be adding commentary, obviously, and we'll do summary as usual. But most importantly, we are waiting for that statement coming out within the next 2 minutes. In the meantime, we can continue to look at the sticks here. We've got Dogecoin still sitting around that 31 cents. Mind Medicine up 14.6%. Microvision pulling back a little bit. Did have a little bit of a run there in the AM, running to 25.75 again. Pulling back a bit to 22.62. We've got Shopify doing very well there, up 10% on the day. Canoe and some of the other autos are doing okay. Canoe's up 4.9%. Churchill Capital up 2.5%. So some of the EVs and autos doing well. Etsy up despite this Pinterest news. Etsy being a recipient from Pinterest. We've got Tesla down 1% at 697. Arcimoto's down almost a little bit of almost a full percent here. So we've got some a real sort of divergence in a lack of consistency in what's happening in this market. Nordstrom's and Macy's were up the other day. Actually, yesterday they were up as well. Today they're down again. It's a very messy market, and I expect this messy market to really continue until we start seeing a little bit more consistency with inflation expectations. And that's a big problem that we're seeing right now. We're going to pull up the 10-year Treasury as well. So that way we have the 10-year Treasury up while this FOMC statement comes up. We'll see how the Treasury market reacts. We'll also pull up, see right now Treasuries are up 1.64%. Usually as Treasuries rise, we do see cryptocurrencies rise as well. Treasuries have been going up every day this week, possibly in anticipation of what's to come here. But big focus on this FOMC statement coming out within the next minute. So excited. Bitcoin at inflection point amid recent sell-off. Ooh, we'll see. We'll see if we get back to that 60K like JP Morgan was looking for. So on standby for this statement right now. Fed decision imminent. Now keep in mind, CNBC often gets these documents 30 minutes before. And let's see if they release anything. I'll check too.
Let's go over to Steve Leisman
for
the Fed decision. Steve.
The Federal Reserve leaving interest rates unchanged after its April meeting and not changing and continuing with $120 billion of asset purchases under its quantitative.
Read that in a moment.
The Fed, for the first time, though, noting progress on vaccinations and saying there's been help from strong policy support. So a bit of an upgrade throughout here to the economy. The Fed has said employment has strengthened, which is an upgrade from the prior statement where it said employment has turned up. He said the pandemic affected sectors remain weak, but those sectors have shown some improvement. That's a new addition to the statement here. And then bingo for David Kelly there. Inflation has risen, the Fed says, largely due to transitory factors. Some out there playing bingo, some playing the drinking game. There's the first transitory of the day from the Federal Reserve. The risk to the outlook from the virus, the Federal Reserve says, remains, and the Fed will continue to aim for inflation above 2%, continue its $120 billion of monthly asset purchases, and is committed to using its full range of tools. So, Tyler, we have a Federal Reserve that is indeed upgrading its outlook for the economy, noting the higher inflation rates that are out there, but once again, not changing policy in the face of that or even the policy outlook for the moment.
Is there anything?
We're going to go ahead and pull back off this. We'll look at the statement here in just a moment. They definitely had that embargoed because they got that summary out fast. Take a look at this. We are at Treasury yields rising at the moment. We're at about 1.65, 1.64-ish now, bobbing around, but a little bit of an increase here intraday. Let's go ahead and go to the statement itself. So here's the statement. Indicators of economic activity and employment have strengthened. We've heard them kind of mention that as well. We're going to go through and look at some of the nuance here. Sectors most adversely affected by the pandemic remain weak, but have shown improvement. And we expect this weakness to unfortunately continue for a period of time until we really get the entire global recovery moving along. So I do expect to see, it was a lot of the recovery stocks, which have priced in near perfection in a recovery, to see some potential weakening over the next few months. However, it's actually the same thing that we're seeing in tech happening as well. Almost that tech and some of the consumer discretionaries being priced to perfection, showing that, hey, now we're getting good earnings, but not beating new, already high expectations, leading to some stocks to sell off, like we've obviously seen here with Pinterest as an example, just in the last 24 hours. Inflation has risen. Here they go, doubling down again on these largely transitory factors for inflation rising. Keep in mind, this is why I believe we're going to see this massive volatility in the stock market for the next 6 months. People are like, oh, Kevin, you bought this stock, it's down, or you bought this stock, you're up, or you're dumb, or you're a genius, or whatever. It doesn't matter. Anything, in my opinion, that we buy over the next few months is going to be going through insanity until we get to September, October, which is when we'll start getting into those inflection points for inflation, where right now we're kind of doing this with inflation. We want to start seeing that decline in inflation coming. But this point right here is probably not coming until September or October. And the Fed is doubling down on this, reiterating that these increases in prices that we are seeing are being caused largely by transitory factors. Overall financial conditions remain accommodative, in part reflecting policy measures to support the economy and flow of credit to U.S. households and businesses. Path of the economy will depend on the virus. Ongoing public health crisis continues to weigh on the economy, and risk to the outlook remain. The committee seeks to achieve maximum employment inflation rate of over 2% or of 2% over the long run. With inflation running persistently below this 2% longer run goal, the committee will aim to achieve inflation moderately above. This is general. This is this is verbatim that we see regularly here. The committee expects to maintain an accommodative stance of monetary policies or monetary policy until these outcomes are achieved. The committee decided to keep the target range for the Fed funds rate at 0 to 0.25% and expects it will remain appropriate to maintain this target range until labor conditions have become more consistent with the committee's expectations. So rates stable, no mention here of tapering so far. The big mention here is doubling down again on their inflation argument. Let's keep rating a little bit here just to see if we see anything else. In addition, the Fed will continue its Treasury purchases, so no taper yet. Same answer here until further progress has been made. So no taper, no rate changes. Still waiting that until further progress has been made, until substantial further progress has been made. In assessing the appropriate stance of monetary policy, the committee will continue to monitor implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. So in other words, if we start getting into price instability, maybe it's time to start making some changes. We are actually seeing Treasury yields tick back down a little bit after some of this inflationary verbiage here. So take a look at this. We had a little bit of a jump. Let's just go to intraday really quick on the 10-year. As an example here, look at that. We had an initial jump on the release of the FOMC statement here, but now we're seeing a decline in Treasury yields, potentially because of the Fed again doubling down on this very, very key line that they inserted here, that inflation has risen, largely reflecting transitory effects. This really can't be understated. I want to make this, let's go, let me pull back a little bit here. Let's go to, we'll just redraw it. Let's do this here. I want to make that a little bit more clear. Remember what we have with inflation going on. The big thing with inflation is that right now, we already saw March inflation come in at 2.6%. We're expecting to see inflation for the month of March, for the month of April, probably year over year come in something to the effect of 3.5. Maybe we'll even see 3.6, could even be vice versa. We might see 3.6 and then 3.5. So we're expecting to continue to see this sort of inflation increase level. And really, if this is the March release, this is the April release, this is the May release, which gets released a month later, we really shouldn't expect to really see this sort of decline in inflation until July to October, in that range. And that's going to be that transitory point where we say, okay, are we finally starting to work off that inflation? Are we finally, going to remove this inflationary pressure from the market by catching up on some of these supply shortages? And take a look at this. Obviously, the Fed's wording here is helping. The Treasury yields still declining a little bit. Not terribly much of a movement here. We're still sitting around 1.64, which is definitely a high for the week. If we go back over the month, we've been declining in Treasury yields with the exception of the last few days here. You can see this straight downtrend with the exception of this uptrend here, which very much follows how Bitcoin has been operating. In fact, this is your annual, year-to-date 10-year inflation or 10-year Treasury reading, which is oftentimes a measure of people's expectations for inflation. We saw that rapid rise here. We saw the flattening in March. We saw this decline into April, but recently we've had a little bit of a bump here. What we can do is let's go ahead and add the Bitcoin index to this. We haven't done this since my Sunday video where I mentioned this correlation. And then what we're going to do is we're going to normalize this by a factor of 100. There we go. Oh, it already was. Perfect. So take a look at this. You can really see Bitcoin, this blue line here, really operating with the 10-year Treasury. On Sunday, a lot of people were like, Kevin, what are you talking about? That doesn't make sense. There's no connection between crypto and the 10-year. There were some comments about that. I shouldn't say a lot of folks. There's some comments like that. I'm like, really? Look at it now. Literally, the 10-year Treasury has been going straight up this week, and so have the cryptos. It's a fascinating relationship, and it's one that you want to pay attention to, because an uptrend in inflation expectations leads to an uptrend in yields on treasuries and seems to lead to an uptrend in Bitcoin prices. I believe that Bitcoin prices move with inflation expectations, and this makes sense why a measure of inflation expectations would trend with crypto. The only time we've really seen an abnormality was right here, and this was because of the Coinbase IPO. If this weren't here, I would have expected this to be a little bit more of a flat to the downside, but we did still see that dip and now that pump over here along with this chart. So we got to pay attention to this. Going back to the Fed statement, no major changes, pretty much the same. With the exception of that one phrase that inflation has risen, largely reflecting transitory factors, that it's so key, the Fed doubling down on their inflation estimates. Let's go take a look and see what Bloomberg's saying here. Federal Reserve officials strengthened their assessment of the economy on Wednesday and signaled risks have diminished while leaving their policy rate near zero and maintaining the 120 bill of monthly asset purchases. We have already read the quotes here. Yeah, let's see. Jerome and his colleagues met again amid growing optimism for the U.S. recovery, helped by widening vaccinations and more aggressive monetary and fiscal support. Biden's obviously expected to unveil his $1.8 trillion stimulus plan later today, although we've already seen a lot of details of that, such as the removing of the the limitation of the 1031 exchange, which I personally think will have disastrous consequences for home buyers. We've got the elimination potentially of the stepped up tax basis, the elimination of carried interest being taxed as a capital gain. I mean, there's so many big changes in Biden's plan here. It's pretty incredible. Let's go see how the indices are doing. I think I can just do a quick look here. World equities. Here we go. I don't want to do futures. I just wanted to get world equities. There we go. World equity indices. So right now, looks like we've got the Dow down about 0.3%, S&P down a slight smidgen here, the NASDAQ down a tiny little bit as well. This is kind of our world market here. Let's go ahead and look at individual stocks to see how individual stocks are reacting to this. We do have Biden speaking in 19 minutes, so we'll take a peek. Let's see if we've seen any specific movement in any stocks. Not noticing anything. I think that's because this statement so far has almost perfectly matched expectations. The stocks that are running are still running. Ethereum actually blowing up at the moment here after this statement release here. The statement was released while Ethereum was $27.15. Ethereum now running up to $27.40. So we've got a movement to the upside in Ethereum. Yeah, let's take a look at where Bitcoin is. Bitcoin at 55,000. Also, over the last 8 minutes here, trending up from about 54,880 to just over 55,000. The same stocks that are doing poorly are doing poorly. Same stocks that are doing well are doing well. Pretty much the same look on the sticks today. Let's take a peek at the Fed here, or let's take a look at rather CNBC here for a moment for some commentary. I'll add commentary as well. I've got Bloomberg here, and we are also ready for Jerome to be speaking shortly.
It's been absolutely boffo. Most of the stocks have been reporting well above expectations, but look at the S&P 500. Earnings started 2 weeks ago with JP Morgan. The stock market has not budged since JP Morgan came out, even though we've had surprise after surprise in most of the big names. That's a sign that the market's bumping up against the limits of its ability to surprise. You want to doubt me on that? Look at AMD. I don't think you can get much better guidance than some of these semiconductors have been reporting, releasing AMD at a great number. And overall, look, doing nothing today on tremendous guidance, well above expectations. So I think we're going to see now the focus is going to be not on the Fed for the stock market. It's going to be on the rate of earnings growth. They can keep that up to keep the market up and around here. And even Biden's legislative agenda is getting a lot more attention from the stock.
Absolutely. On Biden's legislation is going to have a huge impact on the market and market prices. Not only Biden's legislation, but like they said, the rate of earnings growth. We've been doing this with earnings. We've basically just been, earnings have just been straight up. Now we're starting to see that inflection point where it's like, okay, well, now we might flatten at these higher levels. Once we get to growth again in that rate, I think that's when we're really going to see more of a sustained rally in the stock market. A lot of folks are wondering, Kevin, why don't you sell then? Why don't you sell and just wait for that time to come? Because those moments come fast and you don't know when they come. Those rallies can come extremely fast. You can get, there's so many studies that show if you just miss the top few highest return days in the stock market, your returns are dismal compared to what stocks and indices return in a year. So you got to be in the market. You don't want to be out of the market trying to time it, because when that rally comes, it comes fast and it comes in a condensed period of days. And my expectation for that is somewhere between September, October, when we really start seeing that inflection point trending to the downside on inflation. Same thing could be true, by the way, for cryptocurrency. A lot of folks expecting a crypto winter coming. We'll see. Will a decline in inflation and inflation expectations lead to potential declines in cryptocurrency? We don't know. We will see. We will see.
You know, that could have something to do with it. And if they say the Fed isn't going to move until they really start to see certain things in the numbers, I'll tell you a number that'll make a move. If tomorrow you see a 178 10-year and the day after that you see a 210 10-year, guess what? The Fed's going to tell you something new. Really, it's about the markets and what they do and why they do it. Well, nobody exactly knows for sure. We could talk data all day long, but there's trillions of dollars out there that are going to be raining for quite a long time. Kelly, back to you.
I mean, he's not wrong about that. If we saw an insane surge in the 10-year Treasury and inflation expectations really started flying, yeah, he's right. Would be some issue.
30 seconds here. I have the Fed funds futures, Rick, fully pricing in a rate hike in December 2022. Kelly correctly read that the Eurodollar futures is March 2023. Would you square that circle so that Kelly and I can be back in agreement where we always are?
Yes, absolutely. Okay. You just told me that at like 2:16 Eastern, and all those percentages are accurate till 2:16 and 10 seconds. Okay. It would be like you telling me where T-bills are today. And in a year, I go buy a T-bill and I say, oh my God, Steve, you lied to me because T-bills aren't there anymore. It's as good as the breath coming out of the broker's mouth that says it, or as good as the keyboard that typed it. But yes, they're accurate in real time.
Which means they change all the time.
And I guess, Kelly, the story, Kelly, I just want to make one very quick point about this, which is this. The debate is it December 22 or is it March 2023? That, to me, is a huge victory for the Federal Reserve's forward guidance in that the debate we're having is a year and change away. During the financial crisis, the market was always pricing in a rate hike 6 months down the road, 8 months down the road. The Fed has the market at bay in the futures
Janet Yellen and Ben
for at least a year or more.
Too bad they didn't listen. Yeah. Too bad Ben and Janet didn't listen back then. That's all I can say.
No, but I agree. Whether we're talking about December 22 or March 23, we're talking about a long time from now, at least. Thank you both, Rick Santelli, Steve Leisman. Coming up for less than 50.
Wow. Okay. Well, 13 minutes away from Fed Chair Jerome Powell talking. Golly, folks, it's we're going to be in for one heck of a ride. The next 6 months, I tell you, it's going to be more of this. You know, people are asking, hey, when are stocks going to go up again? The answer just consistently is the same. September and October is what, if you're looking for that bump, September and October. That's my take. We got to get through this disaster of a summer. This disaster started in February. I don't think these inflation fears are going to go away until they actually start going away. And guess what, folks? It freaking makes sense. Why would hedge funds think inflation is not happening when the prices of lumber and copper and stocks and housing and everything's going to the moon? Of course, everybody thinks inflation is going to happen because inflation is happening. The question is, what happens once these inflation numbers that are running, when they start pointing back to the downside and we start seeing that reduction in inflation, not just inflation expectations, but also in prices actually coming back down again as we normalize after this crazy screwed up all supply chains. Once we see that correction, that's when I think we can actually really plan. And the concern a lot of people have is, well, look, Kevin, once we go up like this, we're going to keep going up. Okay, well, we'll know that. We'll know if that's true by September, October. If we trend down, well, we'll know that by September, October. It's intense. it's definitely intense, and a lot of things that we have to look forward to here. So let's get into the sticks here briefly as we wait for Jerome Powell. Jerome Powell will be up very, very soon. So no, still consistent here. Spotify and Face Pins still the big losers of the day. Starbucks down 3.44% after their miss there on same-store comp sales. Microvision bouncing around 13% up. Mind Medicine still kicking butt, up 15%. Keep in mind that interview now being rescheduled due to Mind Medicine's compliance issues coming up with this recent uplisting here. Let's go see what Fox Biz has for us. We'll jump on over as well to Bloomberg. Let's see here. Okay, great. So nothing over here. Let's go jump on over. We are 11 minutes away from Jay Powell talking. Keep in mind, Jay Powell, he's one of the people that's almost always on time.
What we're starting to see is offering employees things like flex work, increased health benefits, extra leave. If that starts to take the place of higher wages, are we looking at the right metrics by focusing on higher wages as a measure of inflation?
Well, I think we should look at wages and benefits. So in our job satisfaction survey that we conducted late last year, we found out that consumers, workers were the happiest they'd been in 20 years. In fact, our measure jumped to 56.9%. And a lot of it had to do with some of the things that you mentioned, including more flex time, paid leave, a focus on mental health, also.
Okay, we're going to pull off this. I do want to get back to Fed talk and inflation talk. Keep in mind, use that coupon code to the moon, a link down below for those private live streams we do. We do fundamental deal analysis, real estate deal analysis, stock analysis in the live streams, plus Q&A directly with me. It's a blast every day the market is open. Let's listen in over here.
Actually, I think the Fed is much too relaxed about the fact that they think the Phillips curve doesn't exist very much anymore, that there won't be any inflation coming out. I think they just must keep their eye on the inflation ball and not let inflation get out of control. And that's, I think, really key. They need to communicate that a hell of a lot better, I think, than they're doing.
Yeah, talk to me a little bit about that, because I sense you are at least mildly critical, Rick, of the Fed's communicating, and it does seem that they've been quite careful about telling the markets and the players over and over again that they're not going to touch interest rates for a long time, and they're going to keep buying bonds for a long, long time.
Yeah, I think that this is an issue about how you do what's called forward guidance, which is to provide information about what you're going to do in the future. The Jay Powell Fed has been very reluctant to let people know how they'll react to future events. And I think actually that's a mistake. The issue is that they do, and I think rightfully, have moved to this new framework, which says we don't let bygones be bygones. If inflation's been too low in the past, we want to make sure that inflation actually is a little bit higher for a short period of time, so that the average is actually at 2%. But you do require explaining how you might change your policies, given that there could be change in circumstances. Jay Powell's been very reluctant to do that. It's understandable; they don't like to be pegged down, but this is extremely important, particularly because you worry about having another taper tantrum. You want the markets to understand what you're doing in case the economy keeps on coming in much stronger than they expected, which it has been so recently. If the vaccine does work, which we hope it does, they're going to have to revise their plans a little bit, and they actually should indicate how they'll do that.
But I think you've hit on the idea there that if I were in, or maybe you were in Jay Powell's shoes, the last thing you would want to do would be to tie yourself down to if A, then B, or if A number comes out, then we'll do this. And maybe there are extenuating circumstances, or maybe the consensus isn't there in the room to do that. So I
want to just chime in on this. You know, people say, oh, the Jerome Powell hasn't been clear enough. You know, I kind of disagree with that. I think Jerome Powell has been extremely clear. And every time he talks, he's more and more clear. In fact, in an interview with Sarah Eisen bluntly asked him, hey, you know, if things change, I mean, you're going to have to raise rates, right? And Jerome Powell goes, yeah, I mean, that's the principal tool that we use to control inflation if inflation gets out of hand. So yeah, they'd change their mind and they'd raise rates. They've already signaled that to us. This dude's trying to say Jerome Powell's not being clear enough. I don't know how much more clear Jerome Powell could be. Personally, if I were Jerome Powell, I'd be pissed off every day. Like, I don't get it. Like, I'm being so clear. Like, if the economy keeps booming and we don't see inflation, we don't do anything. If the economy keeps booming and we see inflation through the next 6 to 8 months, we don't do anything. But if inflation keeps sticking around between, say, month 8 and 12 from now, maybe it's time to start tapering, and then maybe it's time to start raising rates. It doesn't seem like rocket science. It seems like Jerome Powell has been very clear. Now you either believe him or you don't. But this stuff about people going, "This just not being clear enough. Yeah, I wish you were more clear." I'm like, dude, have you not been listening to the guy? Come on. It's nonsense. Let's you know what? Forget these people. Let's go to Bloomberg.
Peak growth when you have asset prices levitating ever higher without the wage increases that should follow?
Well, I guess the key thing is that many of the people who are worried about low wages probably don't own any assets. They may not be homeowners, they may not own stocks or bonds, so they're not benefiting from rising asset prices. And potentially those asset prices also don't factor into consumer price indexes. Even though prices are quite high for homes and we're seeing the stock market continue to rally, that's not affecting, Main Street. But I think what Main Street is really concerned about is the fact that they are seeing prices rise, certainly for food and energy. Our own measure of inflation expectations over 12 months is very high. Also, consumers are seeing prices rise for, some of the services that they want. And we do anticipate that there should be a shifting away from high prices for goods towards services, but we're going to see faster inflation, and that's going to potentially give some consumers pause. But again, we're still anticipating very strong growth for this year, 6%, and that's probably conservative compared to some other folks. And even with those inflation expectations that are elevated, our consumer confidence index shows that consumers are happy. They're willing to spend on cars and homes, and they're even thinking about going on vacation.
Yeah, for sure. Thinking about going on vacation. Can't wait to go back on vacation. It's going to be exciting. Let's listen more on inflation here.
Right now, when you look at Asia, when you're looking at the numbers in terms of COVID, still rampant in India, so painful to watch in Latin America, how much does this states? How much is this something that has to keep an eye on?
That the vaccine rollout has been great in the U.S. so far, with roughly half of the U.S. Adult population vaccinated. It's just not true as in India and Brazil, as you said, and so that's going to have meaning for the Fed in terms of trade. Where if the global economy is not performing at its optimal level, that means less trade for the U.S. It also means that even if the U.S. And China are able to really ramp up global growth, you're still going to have economies that are falling behind. And so the Fed want to be very careful about tapering or announcing tapering, knowing that you could have very negative financial market reactions in these economies that aren't as advanced in their recovery from the pandemic.
I'm going to follow on that because, Scott, you were out front on the pandemic, on COVID overall and the global economic consequences of that at a time when everyone thought it would be SARS 2.0. So how are you thinking about India and whether we're being too complacent that the pandemic is basically over here in the US? I mean, in what ways might India surprise us and hurt the global economic recovery story in a way that will be felt?
It's actually a big question because India is just having one HE double hockey sticks of a time with COVID. Jerome Powell now expected within 3 minutes.
Almost a freeze because of how bad the situation is. That reduces trade, that increases the price of imports, and it puts more pressure on the U.S. economy. But I think also, to Dana's point, we have to think about their stability. Without these economies recovering, we're running the risk that it can cascade into a financial crisis. And so from a financial stability standpoint, it's critical that the U.S. help these countries as much as possible to get the pandemic behind them.
We want to thank you so much, Scott Minerd, of course, of Guggenheim, who's been rolling along with us ahead of the Fed event. More the all-important Fed chair, Jay Powell, to take to the press conference. We have but a minute and a half. Tom, what do you think the key watchword for you is going to be?
Key watchword for
Inflation.
me is what he says on wages and what he says on newly
Wages.
employed America. There's anecdotally no question, Caroline, that we're seeing a surge in wages. Michael Ferroli at JP Morgan talks about 7 million jobs being formed over the summer, maybe into the autumn. And that is the recovery from where we were in February of last year. What does the wage dynamic do? Anything he says on that, to me, will be front and center.
But you wonder
And
how much
Scarlett,
of the
of course,
jobs.
meanwhile.
Oh, I'm sorry, Caroline. I just want to
All
add.
right, we're
you
gonna
wonder-
pull back off this. Let's take a quick look at actually, you know what? Give me 1 second here. I want to make sure we've got Fed Chair Jerome Powell ready to go. So let's get this ready. I'm expecting this to be on C-SPAN. That's going to be our fastest access to it. So give us another 30 seconds here. Big shout out to C-SPAN, by the way. They provide some amazing broadcasting. Okay. One of their channels will be showing it. Worst case scenario, we can go directly to the Fed, although C-SPAN will be a little faster. So we are now within 30 seconds of Jay Powell coming out. He's generally very, very much on time. So we'll see. We are on standby any second now for Jay Powell. Jay Powell, where are you? All right, we'll go ahead and pause Bloomberg Live. Still on standby. Okay. Okay, it's going to be on C-SPAN 3. Okay. All right. Here we go.
Afternoon.
We fought that war.
At the measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. Widespread vaccinations, along with unprecedented fiscal policy actions, are also providing strong support to the recovery. Since the beginning of the year, indicators of economic activity and employment have strengthened. Household spending on goods has risen robustly. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also increased. Spending on services has also picked up, including at restaurants and bars. More generally, the sectors of the economy most adversely affected by the pandemic remain weak, but have shown improvement. While the recovery has progressed more quickly than generally expected, it remains uneven and far from complete. The path of the economy continues to depend significantly on the course of the virus.
Keep in mind, he's reading the statement first, then he's going to do Q&A. Nobody cares about the statement. We already read the statement. So he's just doing his reading, then Q&A.
Hospitalizations and deaths. While the level of new cases remains concerning, especially as it reflects the spread of more infectious strains of the virus, continued vaccinations should allow for a return to more normal economic conditions later this year. In the meantime, continued observance of public health and safety guidance will help us reach that goal as soon as possible. As with overall economic activity, conditions in the labor market have continued to improve. Employment rose 916,000 in March, as the leisure and hospitality sector posted a notable gain for the second consecutive month. Nonetheless, employment in this sector is still more than 3 million below its level at the onset of the pandemic. For the economy as a whole, payroll employment is 8.4 million below its pre-pandemic level. The unemployment rate remained elevated at 6% in March, and this figure understates the shortfall in employment, particularly as participation in the labor market remains notably below pre-pandemic levels. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been the hardest hit. In particular, the high level of joblessness has been especially severe for lower wage workers in the service sector and for African Americans and Hispanics. The economic dislocation has upended many lives and created great uncertainty about the future. Readings on inflation have increased and are likely to rise somewhat further before moderating. In the near term, 12-month measures of PCE inflation are expected to move above 2%, as the very low readings from early in the pandemic fall out of the calc. Increases in oil prices pass through to consumer energy prices. Beyond these effects, we are also likely to see upward pressure on prices from the rebound in spending as the economy continues to reopen, particularly if supply bottlenecks limit how quickly production can respond in the near term. However, these one-time increases in prices are likely to have only transitory effects on inflation. The Fed's response to this crisis has been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As we say in our statement on longer-run goals and monetary policy strategy, we view maximum employment as a broad-based and inclusive goal. Our ability to achieve maximum employment in the years ahead depends importantly on having longer-term inflation expectations well anchored at 2%. As the committee reiterated in today's policy statement, with inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. I would note that a transitory rise in inflation above 2% this year would not meet this standard.
Nice.
In addition, we will continue to increase our holdings of Treasury securities by at least $80 billion per month and of agency mortgage-backed securities by at least $40 billion per month.
That was a big statement.
Substantial further progress has been made toward our maximum employment and price stability goals. The increase in our balance sheet since March 2020 has materially eased financial conditions and is providing substantial support to the economy. The economy is a long way from our goals, and it is likely to take some time for substantial further progress to be achieved. Our guidance for interest rates and asset purchases ties the path of the federal funds rate and the size of the balance sheet to our employment and inflation goals. This outcome-based guidance will ensure that the stance of monetary policy remains highly accommodative as the recovery progresses. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can.
Q&A coming up now. This is the big part.
To complete the recovery. Thank you. I'll look forward to your questions.
Yeah, you will.
Thank you, Mr. Chair. First, we'll go to Paul Kiernan.
Hi, Chairman Powell. Thanks for doing this. I guess since I'm first, I'll go ahead and re-up Howard's question from the last press conference. Is it time to start talking about tapering yet? Have you and your colleagues had any conversations to those effects?
Same thing over and over.
Thank you. So, no, it is not time yet. We've said that we would let the public know when it is time to have that conversation. And we'd said we'd do that well in advance of any actual decision to taper our asset purchases, and we will do so. In the meantime, we'll be monitoring progress toward our goals. We first articulated this substantial further progress test at our December meeting. Economic activity and hiring have just recently picked up after slowing over the winter.
It's the same thing, man.
And it will take some time before we see substantial further progress.
Thank you.
Thank you. Jonelle at Reuters.
Wasted your question on that?
Okay, hi, thank you so much. My question is about what's going on with the virus and what if we don't reach a level of herd immunity per se? So in your scenarios, thinking about the outlook in the economy, do you have a model where you might start to still normalize policy, even if there's like a baseline of infections still going on? Or how can you talk about how you're weighing those things?
Yeah. We have to leave questions about herd immunity and what that looks like to the health experts. But I would certainly say that what matters the most to the economic recovery continues to be controlling the virus. The economy can't fully.
Is this Dr. Fauci? Like, come on, questions suck.
Involving crowds of people. There may be people who are around the edges of the labor force who won't come back in unless they feel really comfortable going back to their old jobs, for example. And there may be parts of the economy that will just won't be able to really fully re-engage until the pandemic is decisively behind us. But we've articulated particular guidance for tapering our asset purchases and for lifting off and raising interest rates. So for asset purchases, we've said that we would continue at the current pace of asset purchases until we see substantial further progress toward our goals. So, and that is what it is, substantial further progress. For interest rates,
please get like Sarah Eisen in here to ask a real question. Jeez.
Market conditions consistent with maximum employment. We want to see inflation at 2%, and we want to see it on track to exceed 2%. So those are our tests. We don't have an independent test to do with the virus. I will say, though, as I started with, the path of the virus is going to have an effect on our ability to achieve both of those tests.
Okay. Better questions.
Thank you. Gina.
Hi, Chair Powell. Thanks for taking our questions. I wonder if you could talk a little bit about that test for raising interest rates that you just elaborated. You've obviously made it very clear that you want to see improvements in the real economy, in the real data, and not in just sort of expectations data before making that move. But I guess I wonder what happens if inflation expectations were to move up before you see some sort of return to full employment. It seems like a lot of sort of the stability in inflation has been tied to the fact that those have been so low and stable. And I guess I wonder how your reaction would be, or sort of how your reaction to that is how you're thinking about that.
New York Times here. That was
right.
good.
So it seems unlikely, frankly, that we would see inflation moving up in a persistent way that would actually move inflation expectations up while there was still significant slack in the labor market. I won't say that it's impossible, but it seems unlikely. It's much more likely that we would, having achieved maximum employment conditions, we'd also be seeing 2% inflation and be on track to see inflation moving above 2%. They tend to move together. So that's not to say inflation might not move up, but for inflation to move up in a persistent way that really starts to move inflation expectations up, that would take some time. And you would think that it would be quite likely that we'd be in very strong labor markets for that to be happening. If that actually were to happen, though, there's a paragraph in the statement on longer run goals and monetary policy strategy, which says that when the two goals are somewhat in conflict, we weigh various factors, including the time it would take to get back and forth. So it doesn't really tell you what to do, but it tells you that we will weigh those two factors and how far we are away from them and how long it would take to reach them. Were we to reach that sort of pretty unlikely state.
Thank you, Steve.
Nailed it.
Leisman.
Thank you.
I'm going to quickly put her name up on screen so you know who it was. That was a good question.
And better, you're thinking about how COVID infection rates and the virus calibrate with monetary policy. As you recall, we had a major resurgence in the virus last fall. And I'm wondering, would you need to be assured that there wasn't such a resurgence coming before you began, for lack of a better term, thinking about tapering? And what kind of comfort level would you need? Would it be something that would be declared from the CDC or the World Health Organization, for example, downgrading the virus from a pandemic before you had the comfort level to reverse course on policy? Thank you.
Yeah, we really have just articulated the goals that I've just mentioned a couple of times, which is substantial further progress toward our goals before we taper. Now, that's very likely for us to achieve that. It's very likely going to be the case that we've also made really significant progress on controlling the virus through vaccination and other. Those two things should more or less coexist. We haven't articulated a separate test for a state of the virus that we'd like to achieve, because we're not experts in that area. We're really focused on the economic outcomes. And again, my guess is that it's very likely, it seems to me, that for us to achieve the economic outcomes we would need to taper or to raise interest rates, we would also have to have made very substantial progress in getting the virus under control. Not necessarily fully under control. There is a a possibility, of course, that we will have ongoing outbreaks over the summer, various regional outbreaks, and potentially next winter as well. But we'll be looking for substantial progress toward our goals, substantial further progress toward our goals as we think about tapering asset purchases.
That we have not heard him say before. Potential outbreak next winter. That's what they're talking about. Have not heard that before. That's interesting. 10-year Treasury currently down at 161.
I wanted to ask, you've talked a lot during this crisis about the need to have a lot of help from fiscal policy and monetary policy to make sure that there's not long-term scarring in the economy. And I was just wondering, given all the policies that have been put in place, do you expect there to still be some long-term scarring? And if so, what are you most worried about? Where are you most worried about that showing up?
So I would say that we were very worried about scarring, both in the labor market from people being out of the labor market for an extended period of time. The evidence is clear that it becomes much more difficult if you're out for a long time to get back in and get back to the life that you had. Same thing with these small businesses, many of which are the work of generations. Were we going to wipe out many of those unnecessarily? That was a big concern. I would say that so far, here we are in late April of 2021, we haven't experienced that level of scarring either in the labor market or among smaller businesses. So we're not living that downside case that we're very concerned about a year ago. Notwithstanding that, long limit, where payroll jobs are 8.4 million below where they were in February of 2020. We've got a long ways to go, and also it's going to be a different economy. So we've been hearing a lot from companies that they've been looking at deploying better technology and perhaps fewer people, including in some of the service industries that have been employing a lot of people. It may well be, it seems quite likely that a number of the people who had those service sector jobs will struggle to find the same job and may need time to find work and get back to the working life they had. These were people who were working in February of 2020. They clearly want to work. So those people are going to need help. And so while I would say we haven't seen really highly elevated levels of unemployment for, up in the teens that we thought we might have for an extended period of time, we've still got a lot of people who are out of work. We want to get them back to work as quickly as possible. And that's really one of the things we're trying to achieve with our policy.
Okay.
Thank you, Rachel Siegel.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. The housing market in many American cities is seeing booming prices, bidding wars, and all cash offers well above asking price. That housing is becoming much more expensive for lower income Americans and people who are still struggling from the pandemic. Do you have concerns that there are localized housing bubbles or that there's the potential for that? And what is the Fed doing to monitor or address this? Thank you.
Good.
So we do monitor the housing market very carefully, of course. And I would say that before the pandemic, it's a very different housing market than it was before the global financial crisis. And one of the main differences was that households were in very good shape financially compared to where they were. In addition, most more people who got mortgages were people with pretty high credit scores. There wasn't the subprime, low doc, no doc lending practices were not there. So we don't have that kind of thing where we have a housing bubble where people are over levered and owning a lot of houses. There's no question, though, that housing prices are going up. And so we're watching that carefully. It's partly because there's clearly strong demand and there's just not a lot of supply right now. So builders are struggling to keep up with the demand. Clearly, inventories are tremendously low. We're all hearing those stories. And if you're an entry level housing buyer, this is a problem because it just is going to be that much harder for people to get that first house, and that's a problem. I mean, it's part of a strong economy with people having money to spend and wanting to invest in housing. So in that sense, it's good. It's clearly the strongest housing market that we've seen since the global financial crisis. And, my hope would be that over time, housing builders can react to this demand and come up with more supply, and workers will come back to work in that industry. So, it's not an unalloyed good to have prices going up this much, and we're watching it very carefully. I don't see the kind of financial stability concerns, though, that really do reside around the housing sector. So many of the financial crack-ups in all countries, all Western countries that have happened in the last 30 years have been around housing. We really don't see that here. We don't see bad loans and unsustainable prices and that kind of thing.
Wow. Very big statement on real estate.
Thank you. Chris Rugaber, Associated Press.
Hi, thank you for taking my question. I wanted to ask about the labor market. You see things such as in the Beige Book, you saw in the Beige Book anecdotes about businesses not able to find workers.
Oh, oopsies.
Back to the labor market for fear of getting sick, childcare concerns, and so forth. Do you see these as also just sort of temporary bottlenecks that won't have much effect on the long-term health of the labor market? Or how are you thinking about these kinds of issues?
Chris, you were breaking up a little there, but I think I did get your question. So yeah, I think there are a number of things going on there. The tension between a high level of unemployment and yet many companies saying they can't find, an elevated number of companies saying that they can't find workers. So what's really going on there? It should be a number of different things. There are workers who don't actually have the specific skills that the employers are looking for. There may be geographical differences. It may also be that, for example, one big factor would be schools aren't open yet, so there's still people who are at home taking care of their children and would like to be back in the workforce, but can't be yet. There are people afraid of there are virus fears that are weighing on people, so some people don't want to go back to work. There are also a significant number of people who say they've retired. A large number of people that say that they're retired. Now, it's hard to say whether they will come back in as the labor market strengthens and as COVID, becomes in the rearview mirror in the history books, if you will. So, but clearly there's something going on out there as many companies are reporting labor shortages. We don't see wages moving up yet, and presumably we would see that in a really tight labor market, and we may well start to see that. I do think, so what will happen, what we saw during the last expansion, and it may be a different expansion, we don't know, but what we saw was that labor supply generally showed up. In other words, if you were worried about running out of workers, it seemed like we never did. The labor force participation held up. People came in the labor force, they stayed in the labor force longer than expected. So my guess would be that you will see people coming back into the labor force, and these jobs will be the labor market will reach equilibrium. Maybe pay will go up, but I do think that, and I do think also the unemployment insurance benefits will run out in September. So to the extent that's a factor, which is not clear, it will no longer be a factor fairly soon. So my guess is that we'll come back to this economy where we have, equilibrium between labor supply and labor demand. It may take some months, though.
Mm-hmm. There's some really good arguments in terms of why some people might not be returning to the market yet, labor market, and what it's going to take to get people to come back. We'll summarize, though. Hello? Yeah, I think they're on mute.
We lost you, Chris. Let's go on to Heather.
Thank you. Good afternoon, Chair Powell. I wanted to ask, you've been hearing, of course, these concerns raised by Larry Summers and others about inflation, and the fact that they think the Fed might let things get out of hand with the new policy stance. So my question is, can you tell us what is different this time versus previous periods like in the 60s when inflation got out of control? Why are you confident with the lags in monetary policy that the Fed can get ahead of inflation and make sure it doesn't go too far above the 2% target?
Yes.
Your question. So I actually have a couple of things I'd like to say about inflation, including addressing your question. So let me start with just saying that we're very strongly committed to achieving our objectives of maximum employment and price stability. Our price stability goal is 2% inflation over the longer run. And we believe that having inflation average 2% over time will help anchor long-term inflation expectations at 2%. With inflation having run persistently below 2% for some time, the committee seeks inflation moderately above inflation above 2% for some time. So with a little bit of context, we're making our way through an unprecedented series of events, really, in which a synchronized global shutdown is now giving way to widespread reopening of economies many places around the world. In the United States, fiscal and monetary policy continue to provide strong support. Vaccinations are now widespread, and the economy is beginning to move ahead with real momentum. During this time of reopening, we are likely to see some upward pressure on prices, and I'll discuss why. But those pressures are likely to be temporary as they are associated with the reopening process. And an episode of one-time price increases as the economy reopens is not the same thing as, and is not likely to lead to, persistently higher year-over-year inflation into the future, inflation at levels that are not consistent with our goal of 2% inflation over time. Indeed, it is the Fed's job to make sure that that does not happen. If, contrary to expectations, inflation were to move persistently and materially above 2% in a manner that threatened to move in longer-term inflation expectations materially above 2%, we would use our tools to bring inflation and expectations down to mandate consistent levels. And I would say, if I may, that is a principal difference from, we're all very familiar at the Fed with the history of the 1960s and 70s, of course. And we know that our job is to achieve 2% inflation over time. We're committed to that, and we will use our tools to do that. So that's a very different situation than you had back in the 1960s. There are many, many differences, actually. Let me talk quickly about the two reasons, two or you could say three, but really two main reasons why we think inflation will move up in the near term. The first is the base effects. 12-month measures of inflation are likely to move well above 2% over the next few months as the very low inflation readings recorded in March and April of last year drop out of the calculation. That process has already started to show up. You saw it in the March CPI reading, and you'll see it later this week in the PCE price data. These base effects will contribute about 1 percentage point to headline inflation and about 0.7 of a percentage point to core inflation in April and May. So significant increases, and they'll disappear over the following months, and they'll be transitory. They carry no implication for the rate of inflation in later periods. So that's base effects. The other big one I would talk about is bottlenecks. So this is what we're seeing in supply chains in various industries, and we're in close touch with all of these industries. You know, the Fed has a network of contacts that is unequaled in businesses and in nonprofits for that matter too. So what do we mean by a bottleneck? A bottleneck really is a temporary blockage or restriction in the supply chain for a particular good or goods, something that slows down the process of producing goods and delivering them to the market. We think of bottlenecks as things that in their nature will be resolved as workers and businesses adapt, and we think of them as not calling for a change in monetary policy since they're temporary and expected to resolve themselves. We know that the base effects will disappear in a few months. It's much harder to predict with confidence the amount of time it will take to resolve the bottlenecks, or for that matter, the temporary effects that they will have on prices in the meantime. So, you know, I'll just sum up and say, we understand our job, we will do our job, and we are focused, as you've seen, for many years, we've been focused on inflation deviating below 2%, and we used our tools aggressively to keep it back up at 2%. If we see inflation moving materially above 2% in a persistent way that risks inflation expectations drifting up, then we will use our tools to guide inflation and expectations back down to 2%. No one should doubt that we will do that. This is not what we expect, but no one should doubt that in the event we would be prepared to use our tools.
Wow.
Thank you. James Politi.
That was a very good explanation.
Powell, you said a few weeks ago that it would. Thank you, Chair Powell. You said a few weeks ago that it would take a string of months of job creation of about 1 million to achieve progress towards your goal. Can you define what your definition of a string of months is more specifically? And on inflation, the FOMC said the rise in inflation we're beginning to see largely reflects transitory factors, as you just described. But why use the word largely? And what are the factors driving higher prices that may not be transitory based on the initial data that you're seeing?
So what is a string? What do I mean by a string? Well, I would say what we have right now is one really good. I can tell you what it's not. It's not one really good employment reading, which is what we got in March. We got close to 1 million jobs in March, and a very strong labor market reading. And I was just suggesting that we'd want to see more like that. We're 8.5 million jobs below where we were in February of 2020, and that doesn't account for growth in the labor force and growth in the economy, the trend we were on. So we're a long way from our goals, and we don't have to get all the way to our goals to taper asset purchases. We just need to make substantial further progress. It's going to take some time.
That's a good point.
On largely, there are a bunch of factors. I was really thinking, we were thinking of the base effects and also the energy effects. I wasn't meaning to say there are some real effects. I mean, there are always relative prices going up and down within inflation. There's a basket for CPI or PCE. There are, many factors that go into it. Relative prices are always moving up and down. We think it's very fair to say that the increases we see, and frankly are about to see later this week, are largely due to base effects. It would have been more contentious to say entirely due to base effects, because there are some things that are always going up, and so we just said largely.
Wow. Come on. You can do it.
Hi, Chair Powell.
Unmute.
Thanks for taking our questions. Over the past decade, the Fed has invested significant resources in large-scale bank supervision, has completely overhauled that approach, and it's even created a special committee that looks horizontally across the largest banks to find common risks. Did the Fed not see that multiple banks had large exposures to Archegos? If not, why not? And then what regulation would you like to see implemented to change that going forward?
Yeah, we supervise banks to make sure that they have risk management systems in place so that they can spot these things. We don't manage their companies for them or try to manage individual risks. In the grand scheme of these large institutions, the Archegos risks were not systemically important, or were not of the size that they would have really created trouble for any of those institutions. What was troubling, though, was that this could happen in a business for a number of firms that is thought to carry relatively well understood risks. The prime brokerage business is a well understood business, and so it was surprising that a number of them would have had this. And it was essentially, I believe, the fact that they had the same big risk position on with a number of firms, and they weren't some of the firms were not aware that there were other firms that had those things. I wouldn't say it's in any way an indictment of our supervision of these firms. It in some cases it seems as though there were risk management breakdowns at some of the firms, not all of them, and that's what we're looking into.
Thank you. Nancy Marshall-Genzer.
Better questions.
Hi, Chair Powell. I'm wondering, are you planning to visit the homeless encampment that's near the Fed in Washington that you drive by? Have you been invited? And if you went, what would you be looking to learn there?
What?
Frankly, yes, I have not had a chance to do it yet, but I've been very busy. But I will visit. I don't want to visit at a time of a lot of media attention, because I don't want that to be part of the story. But I will go visit when it's no longer a news story. And I
ask him if he rides his bike too, and what he does at the dentist.
Number of times anyway, let's say. And I think it's always good to talk to people and hear what's going on in their lives. What you find out is they're you. They're just us. I mean, these are people who, in many cases, had jobs, and they have lives, and they've just found themselves in this place. It's a difficult problem, though. There are many facets of it, and I'm well aware that this is not something that the Fed has all the tools for or anything like that. But I will do that when the need arises, and when it's not so much, in the public eye.
Okay, back to inflation, please. We got some big things that we heard so far. Let's go. We want more.
Looking to learn there.
Not really. I mean, I think I know what I'll find there. I think you connect with these people, and what you find is they're like you. That could be you. I mean, that could be your sister. That could be your kid. You always feel that way in that sort of an encounter, and it just is.
You know what we need here is a plug to remind you to use that 39% off coupon code linked down below and expiring May 5th, because that is much more entertaining than deciding what Jerome Powell is going to learn from the homeless camp. Now, don't get me wrong. It's always good to support, but come on, folks. Let's get real questions.
Hi, I wanted to ask about digital currency. You've previously said
Yes.
a few times that you think it's important for the US to get a central bank digital currency right rather than be first. But with countries like China moving very quickly on CBDC, I was wondering what you think the risks are of moving too slow on digital currency.
Right. So I think the first thing to say is that we feel an obligation to understand the technology and all of the policy issues very, very well. Central bank digital currencies are now possible, and we're going to see some of them around the world. And we need to understand whether that's something that would be a good thing for the people that we serve. How would it work in our system? And there are some very, very difficult questions to answer, but I think we are engaged in a serious program to understand both the technology and the policy issues. I would say this: we're the world's reserve currency, and that means that the dollar is used in transactions all around the world far more than any other currency. And that's because of our rule of law, our democratic institutions, which are the best in the world, our economy, our industrious people, all the things that make the United States the United States. That's why we're the reserve currency. And of course, we have open capital accounts, which is essential if you're going to be the reserve currency. So those are the factors that make us the reserve currency. I'm less concerned that another country might have a digital currency first. Ask yourself the question: does that mean that if you were a company that's doing international business, would you then suddenly start to use that currency to do your international transactions, or would you still do them in dollars, which is what everyone does? And I'm not so concerned about that. I am really concerned about getting it right. It is a tricky set of questions that we have to navigate in a world where we already have, remember, a highly evolved payment system. We have FedNow and other immediately available funds. Pretty soon, everybody will be able to do what people do in other parts of the world, which is just use their phone to make immediately available payments all the time. It'll be normal. And what would be the role of a central bank digital currency in that kind of an environment? Far more important to get it right than it is to do it fast or feel that we need to rush to reach conclusions because other countries are moving ahead. I mean, the currency that's being used in China is not one that would work here. It's one that really allows the government to see every payment that's used for which it is used in real time. It's much more to do with things that are happening within their own financial system than it is, I think, to do with the global, sort of global competition.
Thank you. Michael Derby.
Thank you for taking my question. I wanted to ask you another question about inflation, and it has to
Yes.
do with inflation expectations. A number of different surveys and market indicators are showing, multi-year highs in inflation expectations readings. So I wondered, if that was something that you saw as consistent with your inflation outlook. Is that something that worries you, or do you see that as maybe, the success of the Fed's new inflation framework, making it out to the broader public?
Right. Inflation and expectations before the pandemic hit. And here we think of survey, market-based survey being either households or economists and market-based. You look at all of those, and I would say that they were at the low end of what would have been consistent with a 2% inflation target, particularly our 2% inflation target, which calls for 2% average inflation. So they were at the low end. Inflation expectations actually went down a bit at the beginning of the pandemic, and now they've just moved back up to levels broadly that are where they were in 2018, or in some cases 2014. And I would say more consistent with our mandate. And we want them to be. We want them to be higher. and on a persistent basis. We want inflation to run a little bit higher than it has been running for the last quarter of a century. We want it to average 2%, not 1.7%. And for that, we need to see inflation expectations that are consistent with that, really well anchored at 2%. We don't really see that yet, but I would say that break evens have moved up in a way. Break evens are based on CPI, of course, but they're now at levels that are pretty close to mandate consistent, whereas before they were below. We monitor inflation expectations very, very carefully, as you would obviously know. So that's where I would say it is.
Just one small follow-up. Do you have any red lines on inflation readings where if you hit like a certain number on, say, core PC, that would be a trigger response from the Fed?
It doesn't work that way. Inflation measures are always going to be a bit volatile. We expect, as I mentioned, we expect core and headline PCE to move up because of base effects, and and we expect that to go away. We also expect these bottleneck effects to come in. We don't know how persistent they'll be. We think they'll, it's a matter of when they will pass through, not whether they will pass through, but we can't be confident about the exact timing of that or the size of them. They don't seem especially large at the moment, but we don't know. I mean, this is all about the reopening of the economy. That's what's happening. We were in a deep hole a year ago, and now with a lot of help from fiscal policy, some additional help from monetary policy, and a great deal of help from vaccination, we're seeing a strong rebound in activity. And what's happening is demand can be spurred with fiscal transfers and the saved up fiscal transfers and people going back to work and things like that. The supply side will take a little bit of time to adapt. New restaurants will have to be opened. The supply of various inputs into the goods part of the economy will have to be brought back up to speed. And you're seeing some of that. That'll happen over a period of time. Over coming quarters, you'll see some of the bottlenecks resolved, but the last one may not be resolved for some time.
Thank you.
Okay.
Thank you. Brian Chung.
Brian Chung with Yahoo. Hi, Chairman Powell. Brian Chung with Yahoo Finance. I wanted to ask about financial stability, which is a part of the Fed's reaction function here. It seems like to people on the outside who might not follow finance daily, they're paying attention to things like GameStop, now Dogecoin. It seems like there's interesting reach for yield in this market, to some extent also Archegos. So does the Fed see a relationship between low rates and easy policy to those things? And is there a financial stability concern from the Fed's perspective at this time?
Right. So we look at financial stability for us is really, we have a broad framework. So we don't just jump from one thing to another. I know many people just look at asset prices and they look at some of the things that are going on in the equity markets, which I think do reflect froth in the equity markets. But really, we try to stick to a framework for financial stability so we can talk about it the same way each time, and so we can be held accountable for it. So one of the areas is asset prices, and I would say some of the asset prices are high. You are seeing things in the capital markets that are a bit frothy. That's a fact. I won't say it has nothing to do with monetary policy, but it has a tremendous amount to do with vaccination and reopening of the economy. That's really what has been moving markets a lot in the last few months, is this turn away from what was a pretty dark winter to now a much faster vaccination process and a faster reopening. So that's part of what's going on. The other things, though, leverage in the financial system is not a problem. That was one of the four pillars. Asset prices was one. Leverage in the financial system is not an issue. We have very well capitalized large banks. We have funding risks for our largest financial institutions are also very low. We do have some funding risk issues around money market funds, but I would say they're not systemic right now. And the household sector is actually in pretty good shape. It was in a very good shape as a relative matter before the financial crisis. The pandemic crisis hit. There were real concerns, of course, with high levels of unemployment and loss of wages and all that the household sector would weaken dramatically. That hasn't happened. So with the fiscal transfers, money that's on household balance sheets, they're in good shape. You see relatively low defaults and that kind of thing. So the overall financial stability picture is mixed, but on balance, it's it's manageable, I would say. And it's, by the way, I think it's appropriate and important for financial conditions to remain accommodative to support economic activity. Again, 8.5 million people who had jobs in February don't have them now, and there's a long way to go till we reach our goal. So that's what I would say.
As a follow-up, you mentioned money market pressures. The Fed didn't make changes to interest on reserves or excess reserves. What was the logic behind that? It seems like SOFR has been drifting closer to zero. So just hoping for clarification on that.
Right. So the federal funds rate has been well within target and target range, and money market conditions are fine. We have the ability to use our administrative tools to make sure that that remains the case. We do expect further downward pressure on rates through asset purchases and also the runoff in the Treasury General account. But at this point, we didn't see a need to deploy our tools to support rates. And of course, we will do so if the need does arise.
Thank you. Jean Young.
Hi, Chair Powell. I wanted to ask a similar question. We are seeing elevated market valuations, and some economists are concerned that the economy might overheat, at least for a period of time. So should the Fed and other regulators be thinking about tightening capital requirements or extending oversight to the non-bank sector so that financial stability risk stays as low as it has been? Thank you.
So I think capital requirements for banks are, to me, it went up tremendously, really, over the course of the 10 years between the financial crisis and the arrival of the pandemic. And the banks really made it through a real stress test very well, and passed two of our stress tests, and then there's another one that's pending. So capital is in a good place as far as I'm concerned in the banking system. But to your point, what we saw was, so what kind of happened during the pandemic crisis that requires attention? And number one is money market funds and corporate bond funds, where we saw run dynamics again. And we're looking at that. So we're looking at ways, and people around the world are looking at ways to make those vehicles resilient so that they don't have to be, supported by the government whenever there's severely stressed market conditions. It's a private business. They need to have the wherewithal to stay in business and not just count on the Fed and others around the world to come in. So that was that. The other one is Treasury market structure. Dealers are committing less capital to that activity now than they were 10 or 15 years ago. And the need for capital is higher because there's so much more supply of treasuries. And so there are some questions about Treasury market structure, and there's a lot of careful work going on to understand whether there's something we can do about this. Because the U.S. Treasury market is probably the single most important market in the economy in the world. It needs to be liquid. It needs to function well for the good of our economy and the good of our citizens. So it's not clear where that takes you, but we are taking a careful look, and the Treasury Department is really going to be leading this at Treasury market structure and all of the various aspects of that to make sure that we do have a resilient, strong Treasury market that can work even in difficult times. As you know, at the very beginning of of this recent crisis, there was such a demand for selling treasuries, including by foreign central banks, that really the dealers couldn't handle the volume. And so what was happening was the market was really starting to lose function, and that was a really serious problem, which we had to solve through really massive asset purchases. And so we'd like to see if there isn't something we can do do we need to build against that kind of an extreme tail risk, and if so, what would that look like?
Okay, next.
Thank you. Edward Lawrence.
Thank you, Fed Chairman, for the question. So I'm interested in your thoughts. There's so much fiscal help and accommodation from the Federal Reserve. You said today that vaccinations will follow the normal economic conditions or lead to more normal economic conditions later this year. When do you see the economy being able to stand on its own feet, so to speak? And along those lines, with the fiscal spending and the accommodation you talked about with transitory inflation, does more spending need to be injected into the system, or would that affect that transitory nature of the inflation? Thank you.
When will the economy be able to stand on its own feet? I'm not sure what the exact nature of that question is.
Well, what I'm saying is when do you need to lower the amount of treasuries you're buying, sort of taper off a little bit? When can it stand without having that support from the monetary policy side? And then
here we go again.
Transitory.
Okay, sorry. So we've articulated our test for that, as you know, and that is just we'll continue asset purchases at this pace until we see substantial further progress, and we're going to communicate well in advance of any decision. We're going to let the public know that that's what we're thinking, and so there'll be a lot of warning and that kind of thing. But it's about substantial further progress toward our goals. That's really all it is. It doesn't have any external virus-related specific requirement. Although again, I do think the virus will need to continue to be controlled for us to achieve those economic goals. But it's really the economic goals. Now, your second question. Sorry, just say again. I didn't quite get that question.
Yeah, sure. With all the fiscal spending that's happened in the accommodation in it, does the system need more spending, either from the fiscal side or accommodation, or would more spending affect the transitory nature of the inflation and put those upward pressures on inflation long term?
Okay.
So it's really up to Congress. We're not an advisor to Congress. We don't weigh in on specific fiscal bills or proposals. That's really between elected parties. Basically fiscal policy is the province of people who stand for democratic election and win, and they get to make those very difficult decisions, and they get to be accountable to the voters. We didn't do any of that, and we don't have a seat at that table. We don't seek a seat at that table. So that's really something for Congress and the administration to deal with.
Thank you. Greg Robb.
Hi, Greg Robb from MarketWatch. Thank you so much for the opportunity. I wanted to circle back to the housing market.
Circle
it's
back.
Kind of confusing the question and your answer. The housing market is strong, prices are up, and yet the Fed is buying $40 billion per month in mortgage-related assets. Why is that? And are those purchases playing a role at all in pushing up prices? Thank you.
Yeah, we started buying MBS because the mortgage-backed security market was really experiencing severe dysfunction, and we've sort of articulated what our exit path is from that. It's not meant to provide direct assistance to the housing market. That was never the intent. It was really just to keep that it's a very close relation to the Treasury market and a very important market on its own. And so that's why we bought, as we did during the global financial crisis, we bought MBS too. Again, not an intention to send help to the housing market, which was really not a problem this time at all. So, it's a situation where we will taper asset purchases when the time comes to do that, and those purchases will come to zero over time, and that time is not yet.
Thank you.
Great.
Thank you. And for the last question, we'll go to Mike McKee.
Thank you, Mr. Chairman. Since I am last, let me go back to Paul's question, the first question, and ask you whether, not whether you're thinking of tapering, but why you're not. We're seeing bank lending fall. The markets seem to be operating well. Are you afraid of a taper tantrum, or is it, as one money manager put it, if you get out of the markets, there aren't enough buyers for all of the Treasury debt, and so rates would have to go way up? Bottom line question is, what do we get for $120 billion a month that we couldn't get for less?
Ooh.
So it's really not more complicated than this. We articulated the substantial further progress test at our December meeting. And really for the next couple of months, we're made relatively little progress toward our goals. And remember, substantial further progress from our December meeting. And then vaccination started to get more widespread. The economy reopened. We got a really nice job report for March. It doesn't constitute substantial further progress. It's not close to substantial further progress. We're hopeful that we will see along this path a way to that goal. And we believe we will, just as a question of when. And so when the time comes for us to talking about it, we'll do that. And but that time is not now. We're not that far. We've had one great jobs report. It's not enough. We're going to act on actual data, not on a forecast, and we're just going to need to see more data. It's no more complicated than that.
Well, if you leave rates where they are, doesn't change anything. But does it change anything if you actually tapered a bit? If you spent less, would you still get the same effect on the economy?
If we bought less, you're very faint. So if someone has a volume, they turn it up. But if we bought less, no. I mean, I think the effect is proportional to the amount we buy. It's really part of overall accommodative financial conditions. We have tried to create accommodative financial conditions to support economic activity, and we did that. And we articulated the tests for withdrawing that accommodation. And we think, so we're waiting to see those tests to be fulfilled, both for asset purchases and for lift off of rates. And when the tests are fulfilled, we'll go ahead. As we've done this before. We did it in the last after the last crisis, and we'll do it as those tests are satisfied. We'll do it, and the only thing that will guide us are the tests met? That's what we focused on, is have the macroeconomic conditions that we've articulated, have they been realized? That will be the test for tapering asset purchases and for raising interest rates.
Boom. Summary time.
Thank you very much.
Thank you.
Jerome's going out to champagne. And I'm done with my job. All right, let's do a summary. How about that? We'll do a summary and then we'll go over to market closing. Market closing will be a different live stream. Let us do a summary very quickly. Oh, yeah. That was exhausting. Some of those questions are just so bad. It's annoying. I'm sorry. I just get frustrated. All right, y'all ready for this? Hold on. Do a summary of my commentary on what Jerome Powell just said. All right, we'll start out like a new video as usual. Hey everyone, me Kevin here. Here's what Jerome Powell just said in complete summary. First question came out with inflation. We expect inflation to rise over 2%. Jerome Powell expects to see upward pricing pressure from a rebound in spending, especially if the supply chain issues continue to limit companies' ability to respond to that new demand. Expects that these one-time impacts to pricing will be transitory. That's the big theme. That's really been the theme the last few months, that folks, this is not going to stay. This inflation is not here to stay. In fact, Jerome goes deep on his inflation argument in just a moment, which, of course, I will summarize. Now, Jerome Powell also believes that rather than trying to predict exactly what inflation is going to do, let's just wait and see what inflation is going to do and then react. That means, as usual, we're pretty much expecting to wait until October, September, so that way we get the base effects behind us and we give some time for supply chain issues to start solving themselves. So, and this is my opinion, but to me, I don't think there's any way the Fed can have outcome-based guidance until we actually start having outcomes, which we won't start seeing until August, September, October. So then we get into, is it time to start talking about tapering bond purchases yet? This question was asked many different times in many different directions. We even had it asked in reverse, and the answer was consistently a resounding no. That Jerome Powell will tell us well in advance of when it's time to taper, that he will make it extremely clear to America that we are getting ready to taper, and that he's waiting for substantial further progress in the economic recovery. Today, he gave a really cool definition of substantial further progress, by the way, and he kind of did it as an implication. He's like, look, we are 8.5 million jobs down from where we were before. And we're growing at a faster rate now than where we were before. So that, by the way, is borrowing from the IMF and the World Bank, because they said that the growth of America is on this sort of growth trajectory. And the COVID pandemic put that sort of V-shaped into that trajectory. But because of all the spending that's been done, we're not on that same course anymore. We're actually growing at a faster rate. So higher angle, a faster rate than we were before the pandemic. And Jerome Powell's going, look, we're growing faster than ever before, and we're still missing 8.5 million jobs. You think that's close to substantial further progress? It ain't even freaking close. Well, you just stop asking me the freaking question. We ain't close. And so this has kind of been a theme of what Jerome Powell has been saying. And it's interesting to hear him argue that essentially the unemployment number is a very big piece of this puzzle. We'll keep going. He was asked about herd immunity, but obviously he's not Dr. Fauci, so he didn't have an answer for us on that. Then, what if inflation expectations were to go up once we get to a full employment? And so Jerome Powell breaks this into two parts. He says, here's the thing. It's unlikely that inflation is going to move up persistently so that inflation expectations end up going up as long as there's still slack in the labor market. So this is where he's literally tying together what I just said about substantial further progress being when we get all those jobs again, especially since we're growing at a faster rate. He's saying, look, it's really unlikely that we're going to see inflation over like year over year over year when there's so many jobs that still need to be filled, when we still have so much unemployment. It's very unlikely, he says, that we'll see inflation and inflation expectations go up. Keep in mind, inflation is actual prices going up. Inflation, perceptions or expectations, rather, are what we think prices will do in the future. And both of those are very important independently. So he believes that first thing first, we got to get to full employment first. Then we probably can evaluate, are we going to start seeing this consistent inflation? Now, he did say that he'd potentially be open to tapering before we get to this full employment level and before we sort of are able to evaluate exactly what's going on in inflation. So the first thing that will happen is definitely that tapering. He will tell us well in advance of that taper, but a lot of expectations are that we'll start seeing a taper sometime towards the end of this year, maybe beginning of 2022, and then rates to increase 12 to 18 months thereafter. What about if the pandemic reversed course? And this was really interesting because this is where Jerome Powell brought up something we haven't really heard of before. He said, look, there's a very real possibility that we're going to have an outbreak in the winter, like another wave of COVID. And that's something that they're concerned about and paying attention to. That's actually the first time we've heard Jerome Powell mention that about a potential outbreak in the winter actually weighing on their potential decisions. Thought that was pretty interesting. Labor market scarring, not seeing that as a downside risk. Housing market, he says we monitor the housing market carefully, but because we don't have those low quality loans that we've had in 2007 and 8, sure, prices are going up and there's a concern with that, but the issue is not over leverage. The issue is strong demand and a lack of supply. And guess what his conclusion was? We want more housing builders to come and build more homes. That was the solution. He doesn't see bad loans and he does not see unsustainable prices. Unemployment. He says that there are many reasons why people aren't able to go back to work yet. Either they're still caring for their children haven't gone back to school yet. Some people are afraid of getting the virus. Some people are still getting the unemployment boost. And so all of these things will hopefully start correcting the labor market more once we get to, guess what? September and October. It's literally the same time frame we say all the time. Inflation. And remember, the September-October thing is just my deduction from what Jerome Powell says. Inflation. Somebody asked, why are you confident the Fed can get ahead of inflation? And this was really interesting because he breaks down, and I'm going to just keep this short, but he really breaks down, look, we only have two inflationary pressures right now. Number one, base effects, which isn't even really inflation. Base effects are just, all we're doing is comparing to the whole of last year. Of course, numbers are going to be higher this year. So that's not a big deal. And it's certainly not long-term or persistent. Number two, he says that bottlenecks are really the big thing pushing inflation right now. And bottlenecks don't last forever. In a capitalist environment, bottlenecks get solved. And this is why the Fed thinks it's extremely unlikely that we're going to see long-run persistent inflation, despite us seeing inflation now. On recovery, Yeah, this is where he says, look, we don't need to get all the way to our goals to start tapering, but we are a long way away from our goals, especially given the fact that we are still 8.5 million jobs short. On digital currency, he says he's engaged in getting digital currency right, but he's not concerned with digital currency replacing the use of the dollar. He gave this hypothetical of, hey, look, if you're a company, are you going to start transacting with other companies in a cryptocurrency, or are you still going to use the dollar, which has been working fine for a very long period of time? So, the question of this use for currency is still up in the air. Jerome Powell obviously is someone who believes that cryptocurrencies are a tool for speculating in the market, not really a good store of value, and not really proven to be a good currency yet. So he's somewhat mixed on that, but just know his biases on that. Inflation, obviously inflation somebody asked the question like, look, and people are expecting there to be inflation. Isn't that bad with your expectations if you're worried about people's inflation expectations? Well, those are high, aren't they? And Jerome Powell goes, no, not really. The expectations that we're looking at are at the low ends of our expectations. And keep in mind, we want inflation to be 2%. We don't want it to be 1.7%. We want it to be 2%. But inflation readings are volatile, so there's no red line. On financial stability, he says there is some froth in stocks and in the capital markets, says that some asset prices are high, sees leverage in the financial system, but not at levels to where it's an issue, says that banks are well capitalized, that funding risks are low. There are some issues in money markets, but households overall are in very good shape. And overall, the main pillars of our financial system are very, very strong. And he actually expects downward pressure on rates going forward rather than upward pressure. Then he's asked, why are you not tapering? And he says, it's simple. We're not tapering because we have not yet reached substantial further progress, which he did give us a little bit more of a deep explanation on this in this breakdown. So there you have it. Now the best thing to do is check out the program link down below. Take advantage of that 39% off coupon code that expires on Cinco de Mayo. Folks, I cannot wait to have you in there. We go live every day the market is open, answer your questions, and talk about stocks, real estate, finances, you name it. Super excited to have you watch this. Thank you so much for participating. And folks, I am heading over to the market closing live stream now. So if you stand by 1 second, you'll see a pop-up and you'll get the link for the market closing live stream. Let's go and we'll see you there. Thanks.